Hello everyone and welcome to today's Savvy Investor webinar in partnership with Macquarie. Core infrastructure, is it a fixed income substitute, an inflation hedge or a high yielding defensive play? This webinar originally aired live, so if you do hear any references to the Q&A box or resource downloads, that would be why. Without any further ado, I'm going to pass you over to Savvy Investor's Editorial Director, Sebastian Colpin-Scott. I hope you really enjoy today's session.
Today's webinar is on core infrastructure. Core infrastructure has been one of the most rapidly growing segments and has an increasing presence in investor portfolios. Its high yield defensive attributes and long-term nature of the asset and returns on offer have been very attractive for investors with long-dated liabilities. Its inflation hedge characteristics have also made it a very appealing asset class for investors. Now, without further ado, I'd like to pass on to Daniel McCormack, the Economist at Macquarie Asset Management. At Macquarie, Daniel oversees the economic forecasts and assumptions that informs the acquisitions and asset management activities. And he is also responsible for producing the Pathway series of papers, which focus on infrastructure, real estate, private credit, and agriculture. So, sorry, without any further ado, Daniel, it's over to you.
Thanks very much, Seb, and hello everyone. It's a pleasure to be with you today. The title of the presentation is core infrastructure, is it a fixed income substitute, an inflation hedge, or a high yielding defensive play? And to some extent, right, that's a rhetorical question because of course it's all three of those things. But I would also say that core infrastructure is really a play on real interest rates remaining low. And I'll really unpack this as we go through the presentation. But whether real interest rates remain low because nominal interest rates remain low, or whether real interest rates remain low because we get a bit of an inflation surge, it doesn't really matter very much. In either of those scenarios, the outlook for core infrastructure is really quite healthy, in my view. All right, so jumping into the presentation, just skip past these initial disclaimer slides. For those of you very familiar with the asset class, forgive me for this very introductory slide, but for those listeners who just don't really know what infrastructure is, right, have no idea what kind of assets we're talking about here, I just thought I'd explain what infrastructure is just very briefly. So infrastructure is defined by its traits, not by sector nomenclature. So what are those traits? There's a list of them here on the left-hand side, but infrastructure assets tend to provide an essential service to the communities that they are serving and supporting. They often have, some kind of monopoly or monopolistic position, right? They can be capital intensive, there can be barriers to entry to these industries. The demand for the services or goods that they provide often has a sort of low income elasticity, which means it's very defensive and so resilient in bad economic times. Long operational life, stable, predictable underlying cash flows that often have a link to inflation and, low correlation with other asset classes. So an infrastructure asset doesn't have to have all of those traits, but it has to have some. Now, all of that said, there are some sectors where we find that infrastructure assets tend to be concentrated, right? And they are really three in the main: utilities, transport, and digital infra. So, just dropping down a level, what are these types of assets? So, electricity distribution networks such as grids, gas distribution networks such as pipes, district heating, ports, airports, roads. These are all infrastructure assets. Now, what are the benefits to investors of infrastructure, and how does that kind of differ from other real asset classes? The big one is really the third one on that list on the right-hand side there, the inflation hedge. Infrastructure has a really reliable inflation hedge, and I'm going to talk about that quite a bit in this presentation. It also offers, very stable returns, right? It's a very defensive asset class. It's defensive equity, and of course also offers portfolio diversification. And for those investors with long-dated liabilities, because these assets are very long-term in nature, enables you to match those. So that's just a very quick snapshot. Turning to the bulk of the presentation, or the main body of the presentation, starting with fund flows, right? where does infrastructure sit within global investors' portfolios? How big is it, and how is it changing? In short, infrastructure is only a small part of total global AUM, right? It's less than 1%. It's about 0.7% of total global AUM, but it's growing very rapidly. So global AUM grows at roughly 6-7% per year. And since 2014, it has grown at exactly 7% per year, which is the left-hand graph here. Over the same period, infrastructure AUM has grown at almost 17%. And within infrastructure, what we found in recent years in particular is that core infrastructure has been the most rapidly growing of the equity risk buckets. So from 2017 to 2019, which is the latest data point that we have here, core infrastructure AUM has grown at almost 20%, right? So this is a very popular area with investors. So what is driving these fund inflows? What is driving this appeal? Well, certainly infrastructure's good risk-adjusted returns over the last decade or two has been key. But one key factor really is this drop in real yields that we've seen. So this chart just shows the real 10-year government bond yield for the G3, so a GDP-weighted average of the US, UK, and Germany. And what you can see is that from the start of 2017, which is when the flows into core infrastructure really started to accelerate, you've seen real interest rates just continue to drift lower and leg lower through this COVID period. And this is no surprise to me, right? It's no surprise that flows into core infrastructure have accelerated at exactly this time because, as I said at the start, core infrastructure is a play on real interest rates remaining low or going lower. And, as I mentioned, there's two channels, right, through which that can happen. One is nominal interest rates remain low, and the other is we get an inflation surge. So let's just walk through both of those channels to sort of unpack how that impacts core infrastructure and how it's good for the outlook for core infrastructure. So the first, nominal bond yields have, of course, been trending down for decades. Left-hand graph here just shows that, although across the developed world yields have risen a bit this year, they're still extremely low by long-run historical standards, about as low as they get, and pretty much the lowest we've had since World War II. So, the return that you're getting on fixed income assets is really quite low. The amazing statistic is this right-hand graph to me. So, there's over 13 trillion of bonds globally that now have a negative yield. Which is just an incredible number, and that comprises about 20% of the total global bond market, right? Now, when I started my career at the Reserve Bank of Australia way back in the early 2000s as an economist, we were told that interest rates couldn't go negative. They couldn't go below the zero lower bound because cash is always an option for investors, right? Which would provide you a better return than a negative yielding instrument. But, the recent years, the last 3, 4, 5, 6 years have obviously proved that wrong, even though it's kind of an idea with quite a bit of intuitive appeal. But of course, what this is doing is that it is pushing investors out the risk spectrum, right? Because the returns on fixed income assets are really quite low, people are pushing out the risk curve in search of higher returns. And this is happening all over the place. So it's happening within fixed income funds. The left-hand graph here just shows that fixed income funds, both high yielding and standard fixed income funds, are increasing duration in their search for yield and returns, and they're also increasing credit risk. But it's happening beyond the fixed income space. That would kind of be the space you would expect it to happen first, right? And then it sort of cascade out. And that is indeed happening. So, for example, this is a big one in our area of the world, global pension funds, some of these long-term investors, life insurers as well, are pushing into real assets and alternatives in a bid to increase the return of their portfolios. So this is a real slow burn trend, right? These portfolio shifts of long-term investors really take time. So I think what's going to happen if you think that long-term interest rates are going to remain low, perhaps the sort of structural disinflationary environment that we've been in for the last 30 years, remains in play. Now, I think that is up for debate as a macro argument. But nonetheless, if you believe that remains the structural operating environment for investors, long-term interest rates will remain low. The pressure here is only going to build, right? People will just continue to push out the risk spectrum, and places like core infrastructure are just an obvious place to go, an obvious destination, and we are kind of seeing that all the time. So core infrastructure will receive, direct valuation support from low discount rates in that environment. It will also see indirect valuation support from all the fund inflows, and it's also likely to be just a reasonably good operating environment for these assets. So all told, that's going to add up to, a pretty good risk-adjusted return for an exposure to core infrastructure. Now, the other way, of course, that real interest rates could remain low is if inflation starts to move higher. Now, in this situation, you're, of course, likely to see bond yields move a bit higher, but real interest rates could easily remain very, very low in such a situation. And, we're seeing that now across the developed world in particular. It's not just in headline inflation as well, right? It's in core inflation. And there's obviously a huge debate going on right now amongst investors about whether this inflation surge is transitory or whether it's something likely to be a little bit longer lasting. Now, I have views on that. I won't go into them here. It's sort of beyond the scope of this presentation. However, what I would say is I think that the inflation risks have risen, right? And I think a lot of people would agree with that. So inflation risks are higher than they were 5 years ago, 10 years ago, 20 years ago. So whether you think the probability of long-lasting problematic inflation, is 60%, 20%, 10%, 5%, I think a broad swathe of people would agree that it's higher. So from a portfolio perspective, you might be inclined to hedge against this risk. And this is one of core infrastructure's really key traits, is that an allocation to it offers you the ability to do that. So how does this work? And what is the evidence on the idea that infrastructure and core infrastructure provides a good inflation hedge? Now, this is something that at Macquarie we've done a lot of work on. Now, the left-hand chart here shows infrastructure's performance relative to equities and bonds. So equities is the dark green bars here, and performance relative to bonds is the light green bar. And what we've done is we've looked at its relative performance when inflation is above a certain level. And those levels are shown across the x-axis here. So to explain, for example, when inflation is above 1.8%, which is the first set of bars there, you can see that infrastructure has outperformed equities by 3.6% and bonds by 9.9%. When inflation is above 2.1%, it has outperformed listed equities by 5.5% and bonds by 8.4%. Now, the outperformance against bonds when inflation is above average or a bit above average is really no surprise. This is likely to be a challenging environment for bonds, right? But equities do have some kind of inflation hedge in them. It varies a lot by the particular company or the sector that you're talking about, their ability to control margins, pass on costs, etc. But nonetheless, there is some link between inflation and the revenue line. So the fact that infrastructure does better than equities in this environment, and if you look from the bottom left to the top right of this graph, you can see that as we lift the inflation threshold for testing, infrastructure's outperformance against bonds has actually increased. So that just really, I think, adds to the confidence in the results around this, that infrastructure does offer a really quite good inflation hedge. You can do the same analysis for rising inflation, right? So to get to high inflation, inflation's got to go up. So we've looked at that as well. It tells you exactly the same story. Now, one pushback on that kind of analysis is that you could say, well, Daniel, you're looking at the wrong variable, right? The variable that matters is how inflation comes out relative to what's expected. The idea here being that, an asset price is a forward-looking variable, so it has a certain inflation expectation baked into it. So it's not whether inflation is high or low, it's not whether it's going up or down that matters. It's how it comes out relative to what was expected. So we have looked at that, and the results are in the right-hand graph here. So how we've done it is that we've gone back and we've looked at all of the inflation releases since the early 2000s, and we've looked at how they've come out relative to the Bloomberg consensus at the time. So if the actual was higher than the consensus, it's a positive surprise. If if the actual was lower than the consensus, a negative surprise, and then we've looked at all of the positive surprise periods and the returns of the different asset classes in those periods, and those are the numbers that you're seeing here on the screen. So again, you can see that infrastructure does, much better, or has historically done much better than listed equities and bonds when inflation surprises on the upside. Okay, so that's infrastructure. Now, you may ask, why haven't I done this for core infrastructure? Well, the simple answer is that we don't really have a private markets core infrastructure benchmark worthy of the name. So you kind of use infrastructure, private markets infrastructure as a proxy. So the only way you can kind of address this issue directly of core infrastructure's inflation hedges is to go to the listed markets. Now, listed infrastructure and private markets infrastructure, may well be slightly different, right? Risk exposure and a few other things. But, they do have broadly similar traits. So, it's not a bad proxy. It's not perfect, but it's certainly not bad. On this chart, what I've done is I've taken the MSCI indices, and I've taken the core infrastructure indice and the infrastructure in general indice, and I've compared their performance when inflation is above average, when it's above 2.4%, when it's rising, and when it surprises on the upside. And you can see the results here. In every single case, right, core infrastructure has performed better than infrastructure in general. Now, I would say that this is really no surprise, right? Because ex ante, this is exactly what I would have expected. Why? Well, it's because its core infrastructure assets just tend to have a better inflation hedge. Why is that? Well, it's because often, not always, but often, the inflation hedge comes courtesy of regulation, a guaranteed real return, a direct link between revenue and inflation. And what you find is that more of the regulated assets are at the core infrastructure end of the infrastructure spectrum than at the core plus or the value add end. So, my priors would have led me to think that you would get this kind of result. I'm an empirical person, though, right? So it's always very nice to have it kind of confirmed by empirical evidence. So, look, in short, there's just no matter how you kind of cut the data in this space, what it shows is that infrastructure has a really reliable and strong inflation hedge component built into it. That is sort of the evidence for the asset class itself, the sort of asset class level type evidence. But I thought I might just jump into an asset to sort of explain how this works in practice, right? So how does it work at the individual asset level? And a great example of it is this asset, Gothel's Bridge, that we own in New York. Now, this was a project whereby we tore down the bridge that was there, and we built the new bridge, Gothel's Bridge, and now we own and operate the new bridge. The revenue model for this asset is a capacity payment. So what that means is every year we get a payment from the local authority, right? And that payment, the level of that payment is directly linked to last year's CPI. So the payment for this year is directly linked to the CPI outcome for 2020. And the payment doesn't depend on volumes at all. It doesn't depend on how many cars, buses, trucks cross the bridge throughout the year, the month, the quarter. It just, if the lanes are open, we get the payment. So, of course, with this asset, there is an expense line which needs to be managed, right? But this is pretty close to an inflation-linked bond, right? The revenue line has a direct legal link to the CPI. Now, this is not the only way, of course, that infrastructure assets get their inflation hedge attributes. There are other ways. So one that I've already mentioned is that, courtesy of regulation, some assets get a real return, just a direct real return. It's a perfect inflation hedge. Others are like Gothel Bridge, where the revenue line has a direct legal link to the inflation number. Others, there's not a direct legal link, but there's an implicit one, courtesy of the monopoly or the monopolistic position of the asset. It just naturally has some pricing power. It naturally has, an outsized ability to pass on cost increases. So you add all of this up, and of course, what it means is that, across the asset class as a whole, there's just, a large number of assets with a really quite tight link between inflation and returns. And that link is just much tighter, much more direct than is the case for other asset classes. It's much tighter, more direct than is the case for listed equities or just equity in general. All right, some of you, may be sort of thinking, well, how valid is the sort of empirical evidence that I've just presented on, this inflation hedge attribute of infrastructure? Because the infrastructure benchmarks that we have only go back to the early 2000s, and in that period, inflation has been really very benign, right? So of course it goes up and down, and I would say that the empirical evidence in that period is just kind of overwhelming. It doesn't matter, as I said before, it doesn't matter how you cut it. And it accords with what we know about these assets from a bottom-up level. So I certainly wouldn't dismiss that evidence at all. I think it's really quite good. But, there is a case to say, well, okay, it's not real inflation, right? Real inflation is the 1970s. And maybe that would be different. Okay, we can't test that directly because our infrastructure benchmarks don't go back that far. But what I have done is I've gone back to the 70s and I've tried to look at the performance of asset prices through that period, and tried, to draw out from that some attributes that enable assets to perform well in a high inflation period. And then we can kind of look to core infrastructure, right, and see whether they have those attributes. Okay, the first attribute is that, yield really matters in a high inflation environment. In these two graphs, I have broken the total return down, the S&P 500 on the left-hand side here, US government 10-year bonds on the right-hand side, broken the total return down between the yield and the price effect, and compared the inflationary period, 1973 to 1982, with non-inflationary periods, so the periods either side of that period. Now, what you find is that the importance of yield just goes up. So for equities in normal times, non-inflationary periods, the dividend yield accounts for about a quarter of total return. In the high inflation period, it accounts for about 3/4 of total return. If you look at bonds, in the non-inflationary period, the yield is about 100% of total return, right? I.e. the price effects are neutral. But in the high inflationary period, the bond yield accounts for more than 100% of total return. The price effects through that period were negative, right, as expected. So it's just really clear that a high yield is something that is likely to be beneficial to you in terms of performance during a high inflation period. The other thing to be aware of is that, of course, multiples compress, right? So the left-hand chart here, again, looks at the S&P 500, and it looks at the average price-to-earnings ratio in the inflationary period and non-inflationary periods. And in the inflationary period, the average PE is 9.6. It's roughly half what it is outside of that period. Now, this is to be expected, right? Discount rates are going up, and that is going to compress the multiple on which assets trade. One thing that's kind of interesting is the right-hand graph, where I've sort of looked at the equity risk premium through the 1970s to try to get a handle on what was the driver of the increase in the discount rate, right? Was it just the risk-free rate, or did the equity risk premium rise as well? Now, what you tend to find is that what the evidence suggests is that, okay, maybe the equity risk premium went up a bit, right? If you compare what happened in the 70s to what was going on immediately before, it kind of went up a bit. From a longer run perspective, it didn't really get that high. It's hard to say. Maybe there was a little bit of an increase in the equity risk premium, but it was probably only a little bit. And it wasn't as dramatic as you might think if you just sort of casually think back to the 1970s and how disruptive it was from a macroeconomic point of view. Anyway, that aside, so most of the increase in the discount rate is due to the rise in the risk-free. That compresses multiples. What does that mean for how you should position? Well, you should obviously be cautious then. If you think we're going into a high inflation environment, you should be cautious about assets that have a lot of their value a long way into the future, right? High growth assets. You should be looking at assets that have much more of their value in the near term. Okay, so these are the two traits that you want. You want high yield, and you want stuff that is slow growing, a lot of value near term. And of course, that is exactly what core infrastructure offers, right? It offers a really good yield, 5-6%, roughly speaking. Of course, again, depends upon the asset, but really solid yield. And these are slow growing, boring, not sexy assets, right? But in a high inflation environment, that's exactly what you want. So, I've kind of done this inflation argument to death, perhaps, but I think if you are indeed worried about this kind of outcome, then core infrastructure is a great way to hedge it. There are other ways to hedge it, right? So you could get yourself inflation-linked bonds. You could get an exposure to commodities. There are other ways to hedge the inflation risk. What I would say is what core infrastructure offers in addition to that is just a really solid underlying return, right? So you're getting a decent return with the inflation. That's just the real appeal of it. Okay, that's the sort of case for core infrastructure. I'd now perhaps just like to shift gears slightly, or shift focus slightly, and talk about some of the key sectors within core infrastructure and how COVID has affected them, and what opportunities COVID may have thrown up, because there's some interesting stuff that has gone on. So electricity first up. Now, not all electricity distribution networks have a volume exposure, but some do. And what you would expect, of course, is, electricity is a necessity. You expect it to be very defensive. You would expect it to hold up well in economic downturns. And the COVID period really tested that. Now, what we found across the world through this period is there's been a really consistent picture. And that is that countries or economies or regions that were heavily affected by COVID, such as the US, such as the UK, Italy, did see a shortfall in electricity demand relative to normal levels. This is the left-hand graph you can see on this chart. But the shortfall was pretty mild relative to the overall fall in GDP, and it was relatively short-lived, right? Demand returned to normal levels pretty quickly. In those countries that weren't that affected by COVID, and Japan would probably be one, Australia might be another in the initial wave, and of course there are others. So almost no impact on electricity demand. It just chugged along at normal levels. So even though COVID is the largest and sharpest downturn we've basically ever seen, electricity demand actually held up really very well through all of this period. And so really should just reinforce that this is indeed a very defensive place. Renewables is worth touching on quickly as well. The whole renewables and energy transition space is one that has a lot of focus from an infrastructure and a core infrastructure perspective. One of the risks when you go into a downturn, right, is that spaces or sectors that kind of receive government support maybe just get put on the sideline for a while, right? Why? Because governments are short of cash, or they've just got other more urgent priorities, and so they just reduce the subsidies or the benefits or the support that they provide. Very happily, from our perspective, that just has not happened through the COVID period. And in fact, governments have really doubled down on their energy transition and green agendas. Now, one of the contributors to that, is probably the fact that just the climate change situation just has become more urgent over time, no doubt about it. But another contributing factor we would argue is that the cost of renewables has just fallen so dramatically over the last decade or so. And renewables, wind and solar, are now basically on a levelized cost of energy basis, and this is the point of this graph, the cheapest source of energy out there in almost every region of the world. Japan is probably the exception, but everywhere else, wind and solar are cheaper than gas and coal. Now, we have the whole intermittency issue to work through, and energy storage, and all of that. But I think increasingly, what governments are realizing is that this is a space that can stand on its own 2 feet from an economic point of view. And so that has just given them this extra confidence to continue to provide support to this space. And I think what you're going to see, going forward is that, governments are just committed to this. Whatever is required to enable private capital to do what it needs to do in this space, governments will do that. So support is not going away. Digital infrastructure. This is, a super interesting area and a space that has garnered a lot of attention from investors very recently. So why is that? Well, one reason is that, in recent years, we've just seen a lot of increase, or a very sharp increase, in the use of digital infrastructure. So data, broadband, we all use this stuff much more intensely than we did 5, 10, 20 years ago. Now, what happened through COVID is that we saw this surge in activity. So with everybody working, playing, learning from home, what happened was that demand and the usage of all of these sort of subcomponents of digital infrastructure went up. Now, is this likely to be sustained as things start to return to normal? So I would say that what's going to happen is that we will start to see a pullback, right? As people return to the office, as people return to school, you will see a pullback in this demand surge that we saw during the COVID period. But I think but they won't go back to pre-COVID levels, as in there's been a net step up. Why is that? Well, two reasons in my view. Firstly, more people are going to be working from home post COVID than they did pre-COVID. More people will be working from home more often. And secondly, COVID has probably drawn people into this space that weren't there so much before. And what I'm sort of talking about here are older cohorts, right, who really didn't use digital infrastructure very intensely prior to COVID. But COVID has forced them to get online, to set up accounts, to set up payment mechanisms, and got them comfortable with buying stuff online and using digital services. So in that respect, COVID, I think, has been a structural break, right? It has brought demand for this space forward a number of years. The other thing that COVID has done to digital infrastructure has, really emphasised just how critical digital infrastructure is to all of our lives, all of our daily lives, right? We just rely on it so much. So, if you rewound 5 or 6 years, and you spoke to infrastructure investors and you presented sort of digital infrastructure assets to them, you would often get the question of, is it really infrastructure, right? You just never get that question these days. It clearly is. And it's a really interesting area. There's a lot going on. And it is one where there is a lot of investor interest, to be sure. Now, the sector that was impacted the most by COVID was really the travel sector, right? The transport sector. And within the transport sector, it was air travel that was clearly most acutely affected by COVID. So, as COVID broke and as travel restrictions were put in place, flights just basically ground to a halt. And you can see that in the data, right? There's a lot of data on air volumes across the world that all tells you the same story, which we had this just virtually total and certainly unprecedented collapse in activity in this sector. What has happened since then is that we have seen a really rapid recovery, right? As economies have opened up, restrictions have been removed. You've seen this real surge in demand. Now it's being led very clearly by domestic travel, right? You can see that in this left-hand graph, which is for the US, right? The dark green line here is domestic travel. The light green line is international travel. This is revenue passenger miles. You can see domestic clearly outpaces international. You can also see it in the right-hand graph, which is for Europe. Almost every airport shows the same picture. And that makes a lot of sense, right? Because there's still some restrictions on international travel. There's quarantine requirements. There's forms you have to fill out. It's all a bit of a pain. And, it just dampens demand for international travel. So what is the outlook from here? Well, a full-blown return to international travel, will kind of require, it's happening, right? But it ultimately will require that vaccination rates around the world are kind of at some critical level, sort of 80%. So you need the emerging world to really start to vaccinate. That will take a little bit of time, so the international space is going to take a little bit longer to recover. But generally speaking, I would say that in the near term, we think this rapid increase in demand is likely to continue. And one of the things that I think is very much underestimated by forecasters in this space, so if you look at some of the projections by the IATA, for example, I think people here are just not assuming that that there's pent-up demand. They're not assuming that going forward, people are going to want to fly to make up for the flights that they missed in the 18-month period where they couldn't fly. And I think the reason that they're not doing that is because in the downturn following 9/11, there really was no catch-up of the lost demand. If you look at the numbers, it just basically wasn't there. Demand just kind of returned to a normal level, consistent with the level of GDP. But this downturn is different because there's been so much more missed flying. So I think what you're going to see is first, you're seeing activity levels normalize to the level of GDP, right? So, in simple terms, GDP in the US is above pre-COVID levels. Air travel volumes are still well below. So there's a catch-up to come, a normalization to come. But I think also what you could well see is that people A lot of anecdotal evidence for this, right? People want to start to take some of the flights that they miss, to a wedding or, see friends, relatives, whatever the case may be. And so I think you'll actually have an overshoot of that equilibrium before returning, and forecasters are not assuming that. So I actually think that the near-term numbers over the next year, 2 or 3 could be quite a bit stronger than what people are currently assuming. It's also just worth thinking about the longer-term outlook for air travel for a second. One of the concerns is that one of the lessons from COVID is that teleconferencing kind of works, right? It works for a lot of business meetings that we didn't think it worked for prior to COVID. So maybe that will dampen business travel. The first thing I would say, so I think that's real, right? That effect is real, but you've just got to get the quantification of it right. It's really the overall effect is likely to be fairly small. So it's hard to know exactly, but we think that business travel is around about a quarter of all travel. Now, if you're thinking about how much of that can be displaced by teleconferencing, we're reliant on survey data, usual caveats that apply to survey data. However, it's roughly, if you look at the surveys, roughly sort of 45% of business travel is being reevaluated now, right? Of that 45% that is being reevaluated, roughly a third is due to budget constraints, roughly a third is due to health concerns, and then roughly a third is due to the fact that teleconferencing works. So if you assume that the health concerns will dissipate as the virus fades, and the budget constraints will ultimately be lifted as economies return to normal, you're left with just a third of that sort of 45% that is likely to be reevaluated due to this permanent effect, this permanent change that we know that teleconferencing works. If you multiply those numbers out, sort of 25 by 45, by 33, you end up with a number that's sort of 3.5% of total global travel, right? Now, that is roughly 6 months growth. So over the last 10 years, global passenger kilometres have grown at sort of 6.5%. So you're talking about roughly losing 6 months of growth. So the effect, obviously there's uncertainty about these numbers, don't get me wrong, but overall the effect is not huge. It could easily be swamped by the pent-up demand effect, for example. That's much more important. Longer run, the relationship, the real driver of air travel demand is income growth, right? There's a really good relationship between GDP growth or growth in GDP per capita and travel intensity. Cross-country evidence of this in the left-hand graph, where you can see here, each of those dots is a country. The fact there's a trend line from the bottom left to the top right tells you, right, that there's a really good relationship between GDP per capita and travel intensity. There's heaps of graphs like this that you can see around the place. There's also heaps of evidence of this within countries. So you can, there's some data, a survey from the ONS in the UK here on the right-hand side, which just shows that those on higher incomes travel a lot more intensely. You can also look at, the US consumption expenditure surveys, and they show exactly the same picture, right? That people on higher incomes travel a lot more. Travel spend goes up dramatically with income. Travel spend as a proportion of total consumption goes up with income. So these income drivers are really important. And the multiple is higher than 1, right? It varies across country and by decade, but in almost every country, in almost every decade that you examine, the multiplier is above 1, somewhere 1.2 and 2. But above 1. So this is a really strong, long-run underlying demand driver that will ultimately reassert itself, right? So in short, look, I think the near-term outlook for this space is good because of the pent-up demand effect, and the long-term, the sector just has some really strong underlying fundamental drivers. So I think that in this area, if there are some beat-up assets, those are opportunities because the medium to long-term outlook is still healthy. The other transport sectors, just finishing off, are roads. What happened with road volumes through the crisis is that they were hit very hard as the crisis unfolded, but they subsequently just tracked GDP. You can see this in the right-hand graph, which is for the US. You can see the very sharp fall in vehicle miles travelled as the crisis broke, but then it's rebounded very sharply and continued to recover as the economy has continued to recover. You can probably see it even more clearly in the left-hand graph, which is for Europe, where toll road volumes, fell away sharply as the crisis broke. There was then the recovery in Q3 of 2020 as the economy recovered. And then Europe went back into recession, right, in Q4 2021, Q20. And so road volumes slumped back, and now they're moving up again in line with the recovery. So there's a really tight relationship between road volumes and GDP. So what do we expect from here? Well, road volumes are already sort of back to pre-COVID levels, as the economies continue to recover from here, you're likely to see road volumes just do the same. Lastly, but certainly not least, trade and ports, right? I mean, this is a fascinating area, I think, as an economist and sort of an infrastructure specialist. Trade tends to be cyclical. So in an economic downturn, what you would expect is that trade volumes fall by more than overall GDP. And I think as COVID broke, every economist, quietly would have been very worried about trade volumes and port assets. But it just didn't really happen, right? I mean, there was a little bit of a downturn initially in the volumes. You can see that left-hand chart here, which is for the US, right-hand chart, which is for Asia. But it was pretty mild, right? And then we just saw this huge surge in demand and volumes. Why did that happen? Well, two things. One, everybody stuck at home. You couldn't consume services, right? You were forced to consume goods. We all got online and bought a bunch of stuff for our new stuck-at-home lifestyle, and all of those things were goods. And layered on top of that, just to add gasoline to that fire, was the huge fiscal stimulus everywhere around the world, particularly in the US. It was particularly large in the US, but it was everywhere across the developed world, and that just really added to that demand. So we saw this huge surge in goods demand, huge surge in manufacturing activity, and therefore trade. So that caused the spike. Things are starting to come back down again now. Why? The fiscal stimulus has faded, right? There are some supply constraints in this area. So, we're just sort of getting back. We're just kind of like trying to normalize. But looking ahead, there's probably a little bit of downside still to come in these numbers, but they will start to stabilize. And if we think about the medium-term outlook, trade, driven by GDP in sort of any period, basically, outside of COVID. And so, as the global economy just continues to recover, you'll see the same for trade volumes as well, in my view. Very lastly, just stepping back and also thinking about the long-run outlook for trade volume growth, right? And a lot of talk about deglobalization, onshoring, supply chain disruption, etc. And some people are talking about the sort of trade growth, the GDP growth multiplier going back below 1, or going below 1. Now, we do think we're going into a period where globalization will be less intense or going to reverse. We do think supply chain disruption is happening and geopolitical tensions are rising. However, this chart shows the trade growth to GDP growth multiplier for the US, going all the way back to the late 1930s. Each data point here is a 10-year moving average just to smooth out the volatility. The key point is that ratio almost never drops below 1. In fact, the last time that it did on any kind of sustained basis in peacetime was the 1930s, right? So, yes, we are going into a more challenging environment, but are we going into an environment that is as geopolitically as intense and as economic disruptive as the 1930s? No, right? Like, not close. That was just a horrible period of time. So what is the right number here? Well, it's not 2, like it probably was in the late 90s and early 2000s when globalization and the fragmentation of production globally turbocharged trade, but it's also not 1, right? So, of course, the precise number will depend upon the exact port that we're talking about and its geographical and product exposure. As a general rule, for the sector in the aggregate, we would say a number between sort of 1.25 and 1.5 is roughly right. So again, the trade sector, trade growth will, once it starts to bottom out, it will kind of resume in line with GDP growth, and then more longer term, what you're likely to see is pretty healthy and slightly above GDP growth. So look, that's it for me. I'll stop there. I mean, just to recap very quickly, the case for core infrastructure, if you believe that real interest rates are likely to remain low, whether because nominal interest rates remain low or because we get a bit of inflation, that bodes well for a core infrastructure allocation. And I would say the disruption through COVID has also thrown up some pretty interesting opportunities. A lot of focus on digital infrastructure, real opportunities, I think, for any cheap assets within the air travel space, and trade also, I think, is a really interesting space at the moment, and also over the longer term. So thanks very much for listening. I'll stop there and just see if there are any questions. Seb, back to you.
Perfect. Thank you very much, Daniel, and thank you so much for your presentation. You certainly covered a lot of ground, and there's a lot of interesting areas in there. So it's given all of us a lot of food for thought. Can I just say to the audience, firstly, thank you for watching. and we're now switching to our Q&A. So a lot of you have already been sending in questions, but please feel free to send in more. Can I say that if we don't manage to get through all of the questions today, we will cut back to you. Daniel and his team will come back to you via email. So please keep sending them through. Right. So to kick off the Q&A, Daniel, first question for you is: what sector do you get asked about the most at the moment, and what are the key questions that most investors have?
Yeah. Thanks, Seb. I mean, that's a pretty easy one. The sector I get asked about the most is certainly air travel, and you know the critical. I mean, people ask about two things. One is, when will demand get back to pre-COVID levels, right? So I think I've touched on that. I think there's two drivers there. One is just the normalisation of the air travel to GDP growth, GDP ratio. And secondly, this pent-up demand effect, which I think is strong and underestimated. And then there's just this really big question around teleconferencing, Zoom, right, and its impact on business travel. And I think there's a lot of pessimism in that area, as in people are worried that will have a sizable effect on travel volumes. Now, as I've kind of documented, I think the impact is fairly small. But there is perhaps a little bit of confusion around, because people know that business travel is really important for profitability, and it is. It's a huge part of airlines' profitability, disproportionately so. But in terms of total travel volumes, which is what matters for the assets, the infrastructure assets, right, the airports in particular, it is actually only a relatively small amount. So I think the sector will actually be able to weather this, really very well.
Thank you. And so, what do you see as the biggest challenges and concerns for infrastructure for the next 10 years?
I think that, like every space, I would say valuations, have certainly risen. So this is undoubtedly, a place of concern for people. I mean, I think they haven't risen, any more than any other asset class, right? And possibly even less. You think about, where equities are, S&P 500 on sort of 22 times, long run average maybe about 17, something like that. You look at where the property space is, where prices are just at extremely elevated levels relative to history. But it's undoubtedly the case, that infrastructure assets, just courtesy of the fall in discount rates, right, have gone up in value as well. What does that mean? I mean, is that a real problem? I don't think it's a real problem for sort of the relative performance picture, but I guess it just means that perhaps there's not as much easy gains anymore, or there's not much easy returns anymore. The way to get returns is to really focus on operational delivery, right? So I would say making sure that, if you're going to get an exposure to infrastructure, that you're going with an asset manager that knows what they're doing. That would be critically important, or an asset manager that just has a great theme or a great business plan that makes sense to you. That is going to be critically important.
Thank you. And so next question is, do you think that decarbonisation will negatively impact transportation infrastructure?
Yeah, so, fantastic question. I can break it down by sector for you. So for roads and car transport, we think no. And in fact, we think decarbonisation will be a benefit. Why? If you look at electric vehicles are generally more expensive up front, but have a lower per mile run cost, right? So what actually happens as we move to electric cars and buses and trucks, they're more efficient because they have, just far less moving parts and use electricity more efficiently. So the cost of per mile transport is actually going down. Certainly the marginal cost of per mile transport is coming down. So, basic economics tells you drop the price of something, you'll see it used more. So we think that actually as this energy transition proceeds, this will actually be a positive for road volume. So it's good for road owners, it's good for tunnel and bridge owners, etc. Within airlines, certainly a move to sustainable airline fuels, right? And so SAFs are more expensive than fuel, so this is an uplifting cost. Fuel is not, it's not a small component of total cost for airlines, so this matters. But the empirical evidence on the impact that pricing has on volumes is pretty weak. So it varies by level of aggregation, right? So at the route level or short haul sort of route level, there is a bit of price sensitivity because you can delay your trip, you can go to a different city, you can take a train instead. But at the aggregate level, at the national level, the sensitivity of prices onto volumes is really small. I mean, we've just done hundreds of regressions on this, right? And basically, at the national level, every single time, the price effect is small and statistically insignificant. So there may be an increase in cost here. Will it materially impact volumes? I don't think so, and it will be swamped by the income effect, in short. For trade, it could have a bit of an impact, right? I mean, the increase in the cost of fuels will see the cost of trade go up, and that could then dampen trade volumes relative to a situation where you don't. But the effect is, it's not likely to be huge. There's all kinds of ways that you can make shipping more efficient, slow steaming, and these kind of things. So there will be mitigants put in place, but that is probably the one place where decarbonisation may be a slight negative for volumes, all else being equal.
Excellent, thank you. And so, keeping on sort of the transportation theme, what are your thoughts and forecasts about the electric vehicle infrastructure market?
Sorry, I just missed the tail end of that. Seb, was it what are our forecasts for electric vehicle take-up?
Yeah, the electric vehicle infrastructure market. What are your views and forecasts for it?
Yeah. I mean, so clearly, electric vehicles, the take-up is very rapid. I mean, we don't do specific forecasts, but we're constructive on the space, right? And what you're seeing is now, the cost of batteries, which is one of the key reasons for why an electric vehicle has a higher upfront cost. The cost of batteries is just coming down extremely rapidly, and there's more scope for that to happen. So, in time, and it may not be that far off for light-duty vehicles, the upfront cost of an electric vehicle, could be roughly similar to an ICE. And as I mentioned before, the running costs are cheaper. So all of a sudden, on a per mile basis over a lifetime, an EV is cheaper. So we think that this rapid take-up will continue. Now, of course, you need infrastructure to support that. And in particular, you need charging infrastructure to support that. So look, it's kind of already here in a lot of places. In Europe, it's very much here. So, my colleague, Peter Durant, just recently did a trip in his Tesla from London in the UK all the way down to the southern tip of Italy and back again, just to prove that you can do that in an electric vehicle. So the charging infrastructure in Europe is there. It's almost there, in the US, and it's building out everywhere and will continue to do so. That is infrastructure. There's no doubt about it, right? It's kind of monopoly type asset, network effects, all these kind of things that are infrastructure. One caution we have is just the valuations in this space. There are a lot of players that are in this space for their own, commercial reasons. So, car manufacturers are building out infrastructure networks to support the sale of cars. Retail outlets are putting chargers in place to attract customers to the retail store, giving you free charging. So a lot of players are using charging infrastructure as a sort of loss leader for other commercial activities, which from a pure investing point of view, just makes it a little bit harder. So look, we think in time there will be opportunities, but at the moment, there's sort of a lot of money in this space and a lot of people who are, again, sort of, investing in it for other commercial purposes, which just makes it just commercially challenging for us, we've found so far at least.
Thank you. I think we've got time for a couple more questions. So next one I've got here is how would infrastructure perform in the case of higher nominal interest rates and real interest rates?
Yeah, a question we often get a lot. So and there's a bit of a misconception about this. So what people think is that infrastructure is all driven by lower interest rates, and once lower nominal interest rates, and once nominal interest rates start to move up, infrastructure returns are toast. It's just not true, right? It's empirically not true. And in fact, if you go back over the last sort of 17 years or so, when you look at infrastructure's returns, when interest rates are going down and when they're going up, what you actually find is that the returns are higher when interest rates are going up. Now, why is that? It doesn't sound like it makes a lot of sense. The reason is straightforward, and it is that when interest rates are going up, it's usually because GDP growth is accelerating, inflation is picking up, and as I talked about through this presentation, those are the key drivers of infrastructure returns. So when nominal interest rates are going up, what you find is that you have a revenue and earnings kicker from the inflation and the GDP, but you have a headwind of valuations because the discount rate is rising. Now, what the empirical analysis tells you is that first effect is stronger than the second effect, right? So actually, provided interest rates are rising because demand is strong, GDP and inflation are rising, that is actually good for returns within the infrastructure space. If nominal interest rates were rising because of, say, a negative demand shock like the 1970s, right, then it's a different picture, right, because you're not getting that revenue and earnings kicker. But, I mean, every asset class is suffering from this at the same time. So I think in that situation, your absolute returns on infrastructure would undoubtedly fall, but in a relative sense, it still may do quite okay, particularly compared to, say, listed equities or private equity in the like. Look, if real interest rates go up dramatically, it's a similar thing. This is going to be a problem for a whole range of asset classes, infrastructure included in an absolute return sense. But again, it's relatively defensive asset class, right? It has a good yield, so it may actually hold up quite okay in a relative sense in that environment. But for sure, if real interest rates rise sharply, it's problematic for a lot of asset classes out there, and it's going to give a return haircut to a lot of asset classes out there.
Thanks, Daniel. And so last questions. That's all we have time for. How are the rising energy prices affecting infrastructure?
Yes. So far, not in a huge way, right? So energy prices have, of course, risen, particularly in the natural gas space. Volumes have held up, relatively well, right? This is a demand inelastic space. So all of that is holding together, quite nicely. I mean, longer term, we actually think that the problem could be the opposite, right? It could be too low energy prices and electricity prices. Now, the answer to this is perhaps longer than we have time for, but in short, if you're looking at renewables, if they dominate energy supply in the future, they are zero marginal cost supply effectively. Now, if you have a market that is based on marginal, where price is determined by marginal cost, right? You may well have prices drop to extremely low levels, which may disincentivize investment, which means we maybe need to rethink electricity and energy markets and how it all works. And maybe there's some kind of role for governments in that, but that is quite some way into the future. But in short, the short answer to your question is at the moment volumes have held up quite well. Unfortunately, this is a real disposable income hit to households, and that's unfortunate. That'll slow economies a little bit. But in terms of our space, the volumes have been quite resilient.
Excellent. No, thank you so much for your time today, Daniel, and really interesting presentation. I'm sure the audience have enjoyed it as much as I have. Lots of food for thought after this, and thank you for answering our questions. Audience, I'd just like to say thank you for attending. As mentioned, any questions that weren't answered will ensure that Daniel and his team will come back to you via email. Thank you for watching.
Thanks very much, everybody.